There is a pile of bills sitting on your kitchen table right now. Some of them you have been paying your entire life. Some of them arrived this month the same way they arrived last month and the month before that. You open them. You pay them. You move on. What nobody has told you, and what your bank, your insurance company, your county tax office, and your federal government have made absolutely no effort to communicate clearly, is that several of those bills look different now than they did 2 years ago. Not because the amounts changed, because the law changed. In 2025 and continuing into 2026, a combination of new federal legislation, updated state programs, and federal benefit rules created a set of financial exemptions specifically for Americans over the age of 60 that most of the people they apply to have never heard about. These are not loopholes. They are not gray areas. They are formal legal provisions, some passed by Congress, some established by state legislatures, some embedded in federal benefit regulations, that say, in plain language, that qualifying senior Americans either do not owe certain bills at all, owe significantly less than they are currently paying, or are entitled to have those bills covered by government programs on their behalf. According to AARP, only about 8% of the more than 9 million seniors who qualify for just one of these programs have ever applied. That is not a rounding error. That means 9 out of every 10 qualifying seniors are paying bills right now that the law says they should not be paying, or paying full price for bills the law says should be significantly reduced. The money they are overpaying does not come back. It does not accumulate in a fund somewhere waiting for them to claim it. It disappears permanently, month after month, year after year, because nobody told them to ask. If you are over 60 and you are watching this, you are about to find out exactly what those bills are, exactly why you may be overpaying on each of them right now, and exactly what the law says you are entitled to instead. The first bill involves something that changed on July 4, 2025, and that the IRS itself has described as the most significant new senior tax provision in years. It is your federal income tax bill. For as long as most seniors can remember, the federal income tax calculation has worked the same way. You take your income, you subtract your standard deduction, and you pay tax on what is left. If you are 65 or older, you have always received a slightly higher standard deduction than younger filers. But the basic structure has not changed in decades. On July 4, 2025, the One Big Beautiful Bill Act was signed into law as Public Law 119-21. And buried inside it was a provision that the IRS officially described in its April 2026 filing season guidance as a new deduction that is in addition to the current additional standard deduction for seniors under existing law. That new provision is called the Enhanced Deduction for Seniors. It allows every American aged 65 or older to claim an additional $6,000 deduction per person, on top of everything they were already entitled to. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions stacked on top of the existing standard deduction and the existing senior edition. According to CNBC's April 2026 analysis of the provision, a 72-year-old single filer with $70,000 in income can now claim a standard deduction of $15,750, plus the existing $2,000 senior edition, plus the new $6,000 enhanced deduction, totaling $23,750 in combined deductions. For a married couple both over 65, that combined total reaches $46,700. 4 million of American retirees living primarily on Social Security, modest pension payments, and interest from savings, that combined deduction may bring their taxable income to near zero, or to zero entirely. To qualify, your modified adjusted gross income must be below $75,000 as a single filer or $150,000 for joint filers. The deduction phases out above those thresholds and disappears entirely at $175,000 for single filers and $250,000 for joint filers. The deduction is available for tax years 2025 through 2028. It is not permanent. It expires. And the IRS confirmed in its official 2026 filing season guidance that it requires new paperwork, specifically Schedule 1A, to claim. If you filed your 2025 taxes without attaching Schedule 1A, you did not claim this deduction regardless of whether you qualified. The extended filing deadline of October 15, 2026 still applies to anyone who filed for an extension and has not yet filed their complete return. The second bill that millions of seniors are still paying in full, when federal law says it should be covered for them, is their Medicare Part B premium. Every month, $202.90 is pulled directly from your Social Security payment before you ever see a dollar. It happens automatically. Most seniors accept it without question. They assume it is fixed. They assume there is nothing to be done. What they do not know is that a federal program called the Medicare Savings Program will pay that entire premium for them every month, indefinitely, as long as they continue to qualify. The program operates through your state Medicaid office. It comes in multiple tiers. The most comprehensive tier, called QMB, the Qualified Medicare Beneficiary Program, does not just cover the $202.90 monthly Part B premium. It covers your Medicare Part A premium if applicable, your deductibles, your copayments, and your coinsurance. According to Medicare.gov directly, QMB enrollees also pay no more than $12.65 for each covered prescription drug under Medicare Part D in 2026. To qualify for QMB in 2026, your monthly income must be under $1,350 as a single person or under $1,824 as a married couple. Resource limits are $9,950 for individuals and $14,910 for couples. If your income runs slightly higher, two additional tiers, called SLMB and QI, still cover the monthly Part B premium entirely. The income limit for SLMB extends to approximately $1,616 per month for a single person. The QI program extends eligibility further still. For a couple where both spouses pay the standard Part B premium, the combined monthly total being deducted from Social Security is $405.80. If both spouses qualify for QMB, that entire amount stops being deducted every month for as long as they qualify and maintain enrollment. The reason millions of qualifying seniors are not enrolled is the same reason they are not enrolled in most other programs on this list. Nobody enrolled them. Nobody called. Nobody sent a notice explaining the program exists. You have to apply through your state Medicaid office, and you have to know to apply in the first place. Start at Medicare.gov or call 1-800-MEDICARE and ask specifically about the Medicare Savings Program. That one phone call, for a couple where both spouses qualify, could put over $4,800 back in their household every single year. The third bill involves prescription drugs, and a program that most Medicare enrollees have never heard of despite the fact that it fundamentally changes what they pay at the pharmacy counter. It is called Extra Help, also known as the Low-Income Subsidy. And for qualifying seniors, it does not just reduce prescription costs. It transforms them entirely. Under Extra Help in 2026, there is no Part D premium. There is no annual deductible. And the maximum you can pay for a covered medication is $12.65 for a brand-name drug or $4.50 for a generic per prescription. According to Medicare.gov, those are the hard ceilings. They do not fluctuate based on which drug you take or which pharmacy you use. Compare that to what seniors without Extra Help are paying. $50, $80, in some cases over $100 per month for a single medication. Many seniors managing 4, 5, or 6 medications are paying several $100s per month in prescription costs that Extra Help would reduce to less than $50 total across all of them. The income eligibility limit for Extra Help in 2026 is approximately $23,000 per year for a single person and approximately $31,000 for a married couple. These limits are substantially broader than most people assume, and they cover a significant portion of American retirees living primarily on Social Security. There is also a shortcut that most seniors never learn about. If you are already enrolled in any of the Medicare Savings Program tiers, QMB, SLMB, or QI, you are automatically enrolled in Extra Help. No separate application. No additional paperwork. It activates on its own. For seniors who have not applied for either program, the starting point is the same. SSA.gov or 1-800-772-1213. One application can simultaneously address both the Part B premium and the prescription cost issues, potentially saving a household thousands of dollars per year from a single filing. The fourth bill on this list is the one that produces the most visceral reaction from seniors who find out about it, because it involves money that is being pulled from their account every single month for something they may have already been told they cannot do anything about. It is the IRMAA surcharge on Medicare Part B. IRMAA stands for Income-Related Monthly Adjustment Amount. It is an additional premium charged to Medicare beneficiaries whose income exceeds certain thresholds. In 2026, the income thresholds start at $109,000 for single filers and $218,000 for joint filers. Above those levels, the monthly Part B premium escalates from the standard $202.90 to amounts ranging from $284 to $628 per month, pulled automatically from your Social Security payment with no separate notice that the surcharge is being applied. Many seniors who are subject to IRMAA have no idea it exists. They see a smaller Social Security deposit than they expected and assume that is simply the correct amount. Here is what makes IRMAA specifically unfair for retirees, and why millions of seniors are currently paying a surcharge that the law gives them the right to challenge. Medicare calculates IRMAA using your tax return from 2 years prior. If you retired in 2024, sold a property, completed a Roth conversion, or had any kind of one-time income event that temporarily elevated your 2023 income, you are currently paying a 2026 Medicare surcharge based on money you no longer earn and will not earn again. The law provides a formal remedy. It is called a life-changing event appeal, filed on IRS Form SSA 44. If you experienced retirement, a significant reduction in income, the loss of a spouse, or any major income-changing event, you can file SSA 44 with documentation of your current income. If approved, the surcharge is reduced or eliminated going forward. According to financial guidance published in 2026, people who file SSA 44 successfully are recovering $200, $300, and in some cases $400 per month, return to their Social Security deposit every single month for as long as the corrected income figure maintains their eligibility for the lower premium tier. Form SSA 44 is available at ssa.gov or at any Social Security Administration office. If you are currently subject to an IRMAA surcharge based on income from a year that no longer reflects your current financial situation, this form represents one of the most direct and fastest paths to recovering money from a bill you were never supposed to be paying at your current income level. The fifth bill is the one that produces the most widespread overpayment because it affects every senior who owns a home, in every state, regardless of income level. Property taxes. Every state in the United States offers formal property tax relief for homeowners aged 65 and older. Every single state. The programs range from exemptions that reduce your taxable assessed value, to assessment freezes that lock your bill permanently at its current level, to deferral programs that allow qualifying seniors to stop paying property taxes entirely until the home is sold. According to AARP, only about 8% of the more than 9 million eligible seniors have ever applied for property tax relief. The other 92%, the overwhelming majority of qualifying homeowners, are paying full property tax bills year after year on homes they have owned for decades, on fixed incomes that have not kept pace with rising home values and escalating tax assessments. The numbers involved are significant and consistent across states. According to Appeal Desk's February 2026 analysis, home values have climbed past a median of $400,000, dragging property tax assessments up with them. While the Social Security COLA of 2.5% was barely enough to cover grocery inflation, let alone a tax bill that jumped 10 to 20%. The result is a growing class of seniors who are house-rich and cash-poor, people who have lived in their homes for decades, built substantial equity, and now face property tax bills that are consuming an increasing share of a fixed income that cannot grow to match them. The assessment freeze is the provision that most seniors have never heard of, and that carries the most long-term financial significance. A freeze legally locks your home's taxable assessed value at its current level, or at the level it held when you first qualified. It does not matter what happens to home values after that. The freeze holds. Your neighbors without a freeze watch their tax bills climb every year as real estate values rise around them. Yours stays locked. In Texas, the over 65 school tax ceiling freezes the school tax dollar amount, not just the assessed value, but the actual tax payment itself, for qualifying seniors. In Illinois, the Senior Freeze program locks the equalized assessed value for seniors with household income under $75,000. In Arizona, the Senior Value Protection Program freezes assessed value for 3-year renewable periods. Oregon and Minnesota operate deferral programs with no income cap, meaning any senior homeowner who meets the age and residency requirements can stop making property tax payments entirely while they continue to live in the home. The application process in most states requires proof of age, proof of residency, and in income-based programs, documentation of prior year income, typically a federal tax return or Social Security 1099. Most applications are available online through your county assessor's website. Most take less than 30 minutes to complete. And in most states, once approved, the benefit continues for as long as you own the home and continue to qualify. The county assessor's office that sends you your property tax bill every year has no legal obligation to tell you about the exemption that would reduce it. The system was designed for you to find it, not for it to find you. Here is the thread that runs through every single one of these 5 bills. None of these programs come looking for you. None of them activate automatically when you turn 65. None of them trigger when you start receiving Social Security or Medicare. There is no government system that cross-references your age, your income, and your bills and sends you an adjusted statement. Every single one of them requires you to know they exist, to find the right office or website, and to file an application or a form that sets the benefit in motion. The seniors who are paying the least, on their taxes, on their Medicare premiums, on their prescriptions, on their property tax bills, are not wealthier. They are not better connected. They simply did the thing that the system was designed to require and that most people never do. They asked. The law has already been written in your favor on all 5 of these bills. The programs are funded. The applications are waiting. The only variable still outstanding is whether you are going to claim what the government has already decided you are owed. This video is for educational and informational purposes only and does not constitute financial, tax, legal, or medical advice of any kind. All information is sourced from irs.gov, medicare.gov, ssa.gov, AARP, Appeal Desk, CNBC Select, Consumer Affairs, and official state government publications current as of 2026. Eligibility for all programs described varies based on income, age, state of residence, and individual circumstances. Always consult a licensed financial advisor, CPA, or benefits counselor before making financial decisions.